Yesterday, the Federal Reserve dropped a warning that's sending ripples through AI stocks. The Fed is getting nervous about AI. They're worried about the hype that might overheat the economy before the real gains arrive.
Can encourage people to spend out of this wealth in the stock market. And before the AI has actually increased the productivity, you can overheat the economy in the near term.
What Goolsbee is really saying is this: Wall Street and corporate America are pricing in massive future AI productivity gains and wealth creation right now. That's driving huge stock prices going up for some companies, big spending on data centers, and that creates a wealth effect that's making some people spend a lot more money today, increasing demand. And this is happening before the actual productivity boom is showing up in supply in the numbers. So if you have an increase in demand for consumer goods, increase in demand for consumer services, but you don't have a corresponding increase in the supply of goods and services, that drives price up and creates an inflation problem. That risk is near-term inflation spikes, especially with energy prices already under pressure. Maybe tariffs are driving up prices as well. This could keep interest rates higher for longer. The Fed, that's their tool, interest rates, and that puts a damper on AI stocks. It puts a damper on the ability of companies to get financing, to build out data centers, to do the things in order to accelerate AI and accelerate technology. This is classic Fed thinking. It's not that they're anti AI necessarily, they're worried about the mismatch of timing. Long term, they probably believe that AI is transformative, or they're hopeful that it will be. But in the next month, 3 months, 6 months, 18 months, the tension between the hype around AI and the reality on the ground for consumer prices is going to create real volatility for AI stocks. Volatility, volatility, volatility.
On AI, though, my concern, future increases in productivity that make us rich may fuel high equity prices. That they are a increase in your wealth today to know that you're going to be rich sometime in the future.
That's where he started with this, that the idea is you anticipate productivity gains. You anticipate all the great things that AI is going to bring. You anticipate how much money it's going to make these companies that are building AI. Their stocks go up, other related stocks go up, and all these investors have more wealth, and they start spending based on their wealth rather than based on actual productivity gains. And that in his mind, that can overheat the economy.
Are you seeing big increases in consumer spending fueled by stock market wealth increases? Are you seeing data center investment driving up the cost of electricity, of construction workers, and having this short run impact on inflation?
So he's expressing a concern that actually relates to something Jensen Huang said not that long ago. Jensen Huang said, look, we're paying lots of money to construction workers, to electricians, to all these people who are doing all this work building our data centers. And I'm a little fuzzy on why he's describing that like it's a bad thing, right? So it juices the economy. But if data center construction is going to continue and grow, then it's going to juice the economy more. And it's going to mean that there's a lot more real money going into the economy, people doing real things, building real stuff, and that's good. All these workers are going to have money in their hands from actually doing good work, and we want that. I think there's this vision that somehow AI will, and it will, long run, reduce the cost of goods and services. And in some ways, in software, I already see it on the software side in my own personal life. I'm getting access to great AI software for less money. I think this is great. It's doing great stuff for us. But, how do you measure? This is one of those problems with the Fed. How are they measuring consumer prices, right? If I'm using AI to generate videos, if I'm using AI to entertain me, if I'm using AI for all these purposes, and that's costing me less than Netflix, it's costing me less than other things, then it's lowering prices, but you're not measuring the price of my AI use. So I think this is one of the shortfalls of the Federal Reserve is, are they looking at the right data?
We're grappling with the increased costs of computer chips, of electricity, of construction workers, as I described. And you hear that a lot throughout the U.S.
This is one of those things that I think should trouble people about how government officials think is it bothers him that construction workers are getting paid more money. Isn't that a good thing when construction workers get paid more money? I understand that when you build data centers, you increase electricity use. You build other businesses, you increase electricity use. That's economic growth. Economic growth is good. So, economists have this view of like the Fed's job is to worry about inflation, inflation, inflation. And like, well, if we have economic growth, then you're going to have these lags. Are you going to get in the way of the economic growth? Is that a good thing long term for the economy and society?
And I said, what's the biggest problem facing the economy in Cedar Rapids? And they said the data centers using up all the power, our electricity, and we can't find anyone to build out housing for our workers.
So there's a sentiment that they're hearing when they travel around the country, when they go to different places, that we've heard this before, people complaining that data centers are increasing costs. And if you're increasing costs for housing because more workers can afford housing, I just find it troubling that these guys can think that's a bad thing. It's like, I don't understand what you're trying to do. I don't know if you understand what you're trying to do. I know they're trying to do good things, but when you just take a look at that and you say, well, we don't want construction workers to make more money, and we don't want to have businesses that use electricity. It's like, so you want all the business to go to China and you want the Chinese workers to make money, but you don't want American workers to make money, and you don't want us to have business in America?
The non-AI economy, the hotter that gets, the more frothy that feels, they can, in a sense, pay the price. It's a little hard to separate out, though, from what was the impact of tariffs that hit the supply chain and raised the cost of production, too, and what's the impact of oil prices.
To his credit, at least he acknowledges, hey, we see this stuff happening with data centers, but there's these other things going on, and it's difficult for the people who run the Fed to diagnose, wait, is this problem caused by AI data centers? Is this problem caused by tariffs? Is this problem caused by energy conflict in the Persian Gulf affecting energy prices? And, maybe that's driving up, gas prices in America. How do you separate out all these things? So I didn't really love his, he's a very personable guy. I enjoyed watching him talk. He has a nice style about the way he speaks, but sometimes that covers like, we've got to control your economy. We want to keep you from growing. We want to keep, we think we know better about the economy than you do. And, it's a tough spot because they're supposed to keep inflation from happening, and they think they know what they're doing. And my experience is they don't have a good track record. And I think they should just get out of the way and let the economy figure it out. But easy for me to say. Let's move on. All right, let's talk about what this actually meant for the market yesterday. It was a mixed session for AI stocks, as you can see. The pure compute names gave back some ground as traders digested the Fed's caution on hype versus reality, but the infrastructure layer, especially memory, continued to show real strength. You can see Micron here up 3.6%. A couple of the hyperscalers, Meta and Amazon, were up. TSMC up a bit, Tesla up a bit, a lot of red. A lot of red everywhere else. Micron was a clear standout. It extended its rally, pushed deeper into trillion-dollar market cap territory, and reinforced the story that high bandwidth memory is now one of the tightest bottlenecks in the entire AI build out. There's so many bottlenecks. I did a deep dive last night myself. It's coming. I'll be doing a deep dive video on this soon. I did a deep dive trying to get a better understanding of what's going on with high bandwidth memory, what's going to happen in China, how are these chips and racks put together, how does the memory fit into all that. I'm learning along the way about AI and AI stocks, and I'm trying to share what I learned with you. So I'll be talking more about that in the near future. Meta and Amazon held up relatively well. Wall Street saw their continued heavy AI capex as a positive signal. Its companies are not slowing down their infrastructure spending, even with macro noise. And Google didn't really move. Oracle down slightly. The rest of our primary eight were soft to flat. Nvidia, several other core AI names saw some profit taking as the higher for longer rate narrative got another look. The bottom line from yesterday is the Fed Goolsbee's comments introduced near-term caution around AI overheating risks, overheating the economy risks, sparking some rotation into defensive stocks. That's just part of the volatility. But the underlying infrastructure build-out narrative, particularly around memory and hyperscaler spending, refused to break. Looking ahead to today and the rest of the week, markets will continue digesting Goolsbee's remarks. There'll probably be a lot of talk about whether the other Fed board members feel the same way. Watch for any follow through on inflation fears. Is there going to be any fiscal policy? I didn't include it in the clips, but he talked a little bit about some of those issues are fiscal policy issues rather than Fed policy issues. So will the federal government do something about any of this? Momentum from Micron might spill over positively to the broader supply chain. We should all be paying attention for fresh AI CapEx commentary from the hyperscalers. Meta, Amazon, and Google. And of course, SpaceX is now becoming a hyperscaler as well. Another thing I've learned recently is the term neo cloud. I actually spent like 30 minutes, an hour trying to figure out if I could start a neo cloud, and probably a little bit more money than I can afford to spend right now. And where would you put a neo cloud, which is like a medium-sized data center? Remember, this is exactly the kind of short-term volatility we track every day. The long-term AI transformation still has years to run. These macro stories, these other, various things come along and they can create little bumps and dips along the way. For our Pod Watch segment, here are 3 notable pods from the past 48 hours that are worth paying attention to. First up, This Week in AI with Jason Calacanis. That's Jason over here. He blocked me on X. From the All In Pod, he has his own stuff. He's done a lot. I don't hate him. He blocked me. I'm not fond of that. His panel included Eric Bernhardson from Modal, Tanay Kotari from Tancoats, doing Whisper Flow, and Richard Socher building recursive self-improving superintelligence. That's cool stuff. So this was a high signal roundtable. They broke down Andre Karpathy joining Anthropic's pre-training team, a big talent signal about where the frontier is heading. They also dove deep into open source agents, why LLMs still struggle with structured enterprise data, and the rise of vertical AI applications. One of the more interesting threads was the idea of AI etiquette, that your output is ultimately your responsibility, and concerns around power concentration, as a few big models know more about us than our closest friends. So true. This episode reinforces that the real action is moving from raw model scale to practical agents and vertical tools. Strong builder energy, even as the market digests macro caution. Check that out, This Week in AI with Jason Calacanis. I find it a little harder to take this one seriously, but Josh Bersin did a podcast on the Pope's encyclical on AI. I think it's only 11 minutes long, so maybe it's not too hard to watch. Thoughtful solo episode reacting to the Pope's new encyclical on AI titled Magnifica Humanicus. Magnifica Humanitas. He frames the document not just as a warning about risks like deepfakes and job displacement, but as a deeper manifesto about power, values, and preventing AI from concentrating control away from ordinary people. That's the Pope's job. That's the church's job. That's government's job, to concentrate power away from ordinary people. We don't want AI to concentrate power away from ordinary people. We don't want big tech to have that power. We want that power for ourselves in the church and in governments. I might be a little cynical. He draws a fascinating parallel to the Tower of Babel, humanity's attempt to reach godlike capability and the consequences that followed. I don't think we're trying to reach godlike capability. I think we're worried that AI will reach godlike capability without us being in on it. It's refreshing to hear enterprise-focused analysis that steps back from pure hype and asks bigger questions about ethics, power structures, and long-term societal impact. Worth listening to if you're thinking beyond quarterly earnings and even long-term investing. I'm a little cynical about the Pope's opinion on this stuff, but hey, if that's your cup of tea, enjoy it. Take a taste. And then finally, we have NPR's Endpoint tackling Google's aggressive rollout of AI-generated search answers. I struggle with, who am I less interested in their opinions about things, NPR or the Pope? I don't always love Jason, but I'll put Jason way above these people. But, all right, we'll give them a shot. The discussion explores whether giving users synthesized AI summaries instead of traditional links will destroy the economic model of the open web. Yeah, that's a real problem. Publishers are worried about traffic collapse, while proponents argue it delivers faster, better answers for users. I don't know. I use this stuff all the time. If I want to dig deep, I don't trust the AI. I dig deeper and I go find the link. It actually leads me to, I might do a Google search. I might tell the AI to give me a link. They unpack the tension between convenience and the health of the broader internet ecosystem. This just sounds like such NPR snobby BS. Classic example of the AI economics theme we talk about often. Short-term user experience gains could create massive disruption for content creators and the entire information economy. Here I am as a content creator creating content about AI, and it's creating massive disruption for me. It's empowering me. What are you talking about? Google is all in on this shift. It'll be one of the biggest real-world tests of AI's societal impact this year. The Fed is watching AI hype closely and warning about near-term overheating risks, which created some short-term pressure on AI stocks yesterday and may be pushing the stocks going forward. But underneath that noise, the infrastructure build out, especially around memory and hyperscaler capex, continues to show real strength. All kinds of things happening on the supply chain. This is exactly the kind of volatility we track every day. Long term, we're still extremely bullish on the AI transformation playing out over the next several years. I'm bullish. If you're interested in my weekly options report for paying supporters, I look at 2 year plus long leaps and my custom metric for evaluating those leaps. I'm dropping another update today. Become a YouTube channel member. Please support me as a subscriber on X, Patreon as well. If you're not already a subscriber here on YouTube, please subscribe and set up notifications. Please follow me on X, WR4NYGov for daily updates and clips. Back tomorrow with the next AISR. Thank you for watching.